Uber expanded across the world at a speed few companies had ever achieved, operating in hundreds of cities while becoming a part of everyday life for millions of users. The company raised tens of billions of dollars and built a platform that handled millions of rides every day. From the outside, it looked like a perfect growth story driven by scale and technology. But behind that growth, Uber was losing money on a massive scale, accumulating over $30 billion in total losses over time. Each ride added revenue, but also added cost, creating a system where growth increased activity without improving profitability. Low prices attracted users, while incentives were used to keep drivers on the platform, keeping the system running. This meant the business depended heavily on continuous funding rather than self-sustaining operations. For years, investors supported this model, expecting that scale would eventually turn losses into profits. What looked like unstoppable growth was actually a system where expansion was amplifying losses instead of solving them. The turning point became clear in 2019 when Uber went public and revealed the full scale of its financial position to the market. The company reported a loss of approximately $8.5 billion in a single year, one of the largest annual losses ever recorded by a newly public company. This was not a one-time issue, but the result of years of spending that had supported rapid expansion. Investors who had previously focused on growth began shifting their attention toward profitability. The stock struggled after the IPO, reflecting growing concern about whether the business model could ever generate consistent profits. For the first time, the assumption that scale would fix everything started to break down. Uber was no longer being evaluated as a future opportunity, but as a business that needed to prove it could sustain itself. The gap between revenue and actual profitability had become too large to ignore. What had once been a growth story began to look like a system under pressure. Uber's model appeared simple. Connect riders with drivers through an app and take a percentage from each trip. The simplicity of the idea allowed the platform to scale rapidly across cities and countries. As more riders joined, more drivers were needed, increasing activity across the network. This created the impression of a self-reinforcing system where growth would naturally lead to profitability. However, the pricing strategy was designed to prioritize expansion rather than margins. Ride fares were kept low to attract users, often below the true cost of delivering the service. At the same time, drivers were offered incentives and bonuses to remain active on the platform. These payments increased supply, but also raised the overall cost of each ride. The system was growing exactly as designed, but the economics behind it were already under strain. As Uber scaled, the gap between what a ride cost and what a rider paid became more visible. In many markets, fares were effectively subsidized to remain competitive and maintain demand. This meant Uber was covering part of the cost on each trip rather than earning from it. At the same time, driver incentives continued to increase to ensure enough supply during peak demand. The combination of low pricing and high incentives created a model where each transaction carried pressure instead of profit. Growth increased the number of rides, but did not improve the underlying economics of those rides. The more the platform expanded, the more capital was required to sustain operations at scale. This turned growth into a funding-dependent system rather than a self-sustaining one. What appeared to be momentum was increasingly becoming a cycle of expanding losses tied directly to activity. As Uber expanded into more cities, competition intensified, especially from Lyft and regional ride-hailing platforms. Price competition forced Uber to keep fares low, even as operational costs continued rising. In many markets, this led to aggressive price wars where profitability was not the priority. At the same time, regulatory pressure increased, with cities introducing rules that raised compliance and operational costs. Driver classification debates added further complexity, increasing uncertainty around labor expenses. Uber also expanded into new services like food delivery, increasing both opportunity and financial exposure. These expansions required additional investment, extending the period of sustained losses. The company was now operating across multiple fronts, each requiring scale before profitability could be considered. What had started as a single growth engine had turned into a system managing multiple sources of pressure simultaneously. By the time Uber became a public company, the availability of capital began to change, reducing the ability to fund losses indefinitely. Investors started demanding a clearer path to profitability rather than continued expansion at any cost. This shift forced the company to reconsider how much it could spend to maintain growth. Reducing driver incentives and raising prices became necessary steps to improve unit economics. However, these changes carried risk, as higher prices could reduce demand and lower incentives could affect driver supply. The balance between growth and profitability became increasingly difficult to manage. The model could not sustain both rapid expansion and improving margins at the same time. Decisions that improved financial performance often slowed growth, while growth-focused decisions increased losses. At this point, the system reached a stage where trade-offs became unavoidable. After the IPO, Uber's stock struggled to maintain its valuation as investors reassessed the business under stricter expectations. Losses remained significant, forcing the company to introduce cost reductions and operational changes. Uber exited several unprofitable markets, focusing only on regions where scale could improve efficiency. Layoffs and restructuring became part of the strategy to control expenses. The company reduced incentives and adjusted pricing to move closer to sustainable unit economics. These changes improved margins but slowed the pace of growth. The business shifted from aggressive expansion to disciplined execution. Uber was no longer trying to dominate every market, but to survive within a more balanced structure. What had once been a growth-at-all-costs model was now being reshaped into a system focused on sustainability. In the years that followed, Uber began moving closer to profitability by reshaping how the platform operated. Pricing became more disciplined, and incentives were reduced to align costs with actual demand. The company expanded into Uber Eats and logistics, creating additional revenue streams beyond ride-hailing. These segments helped improve overall margins, but required careful management to avoid repeating earlier mistakes. By 2023, Uber reported its first annual operating profit, marking a significant shift from its earlier loss-driven model. However, growth was no longer driven by aggressive expansion, but by efficiency and cost control. The business had transitioned from a system powered by funding to one that needed to sustain itself. This shift changed how the company was evaluated, focusing more on profitability than scale. The case showed that rapid growth can hide structural weaknesses, but those weaknesses eventually surface when funding conditions change.